Apart from this, another very important concept of a budget is a concept of FRBM. Now, what do you understand by FRBM? Before looking at the points, look at the concept here. There is a concept of a revenue deficit. What do you mean by revenue deficit? Under the budget account, I'll put the figure again. Under the concept of a budget, there is a revenue side and there is a capital side. And under the revenue, there is a expenditure and income. Under the capital, there is a expenditure and income. Now look at this. When I say revenue deficit, it simply means what? The revenue expenditure is higher than the revenue income or the revenue receipt. Now the problem is this. Revenue side is not associated with an asset. It doesn't deal with an asset. It deals with consumption. That is consumption type. Government of India, if it incurs an extra expenditure compared to how much income it is going to generate, it basically means that it is spending extra for consumption purposes. And this particular expenditure is not considered to be favorable. For a simple reason, it doesn't lead to creation of an asset. This kind of an extra expenditure could be because of a subsidy regime of the government, could be because of a reduction in the tax receipts compared to the expenditures, so on and so forth. There could be multiple reasons why there is a revenue expenditure. But what is the negative feature associated with this revenue deficit? Is that to bridge this particular revenue deficit, you need to have money. Yes, please understand, if you are spending 100 rupees here and you are collecting only 80 rupees here, don't you think you should be able to bridge this particular 20 rupees? That is extra expenditure of 20 rupees. Because please remember this, you can postpone the decision with respect to investment. But it is very difficult to postpone the decision with respect to expenditure. For example, Government of India cannot simply say that this year no subsidy will be given. Rather than giving this year, we will give the subsidy next year. People will not be happy. Government of India cannot say that interest payment will be not given. That is the reason the revenue deficit has to be bridged. Now, where will you get the money to bridge this revenue deficit? Government of India takes the money from the capital side. So look at this. In the capital side, the only way Government of India can raise money is through borrowings. Again, I am saying raise money, not collect money, raise money. So the Government of India is borrowing from the market for consumption purposes. That means government is borrowing in the market, and rather than using this particular borrowing for asset creation purposes, it is using it for consumption purposes. There is a rule which is called as a golden rule of budgeting. What does this particular golden rule basically state? It states that government should not borrow from the market for consumption purposes. You borrow, but for creation of an asset, but never for consumption purposes. For a simple reason, for every borrowing done by the government, there is a repayment liability. That is, if Government of India borrows 100 rupees today, it has to pay back 100 plus interest after 1 year, let's say. If you have not used this money effectively for asset creation purpose, which will provide economic benefits in the future, you are having a wasteful expenditure. That is the reason the golden rule states, borrow from the market only for the creation of an asset, never for consumption purposes. So when government has revenue deficit, it means it has to borrow and use it for consumption purposes. That is one issue which is plaguing the budgeting concept in India. Now, how can you bridge this particular revenue deficit? Government says, either I can control the revenue expenditure. For example, they are rationalizing the subsidies now, which will basically lead to what? Reduction in the revenue expenditure. Or else, I can collect more tax revenues, or tax receipts to be more precise. For example, introduction of GST. So Government of India presently is taking measures which are aiding government in reducing this particular revenue deficit. So basically this is a concept of a revenue deficit and negative features associated with the revenue deficit. Now there is one act which has been passed by the government which deals with these kind of deficits. This act is called as FRBM, Fiscal Responsibility Budget Management Act. This act uses a term called as intergenerational equity, or else it is also referred as intergenerational parity. What do you mean by intergenerational parity or equity? I'll give an example. Let's assume there is a government X and today it borrows heavily by issuing what? G securities. And let's say G securities will mature after a couple of years. Now this particular government, for whatever reasons or purposes, has borrowed heavily from the market, and after a couple of years, the same government or a different government has to repay the principal as well as the interest. Since the borrowing this year is very high, this particular borrowing has to be repaid once the maturity period is obtained. And when the maturity period comes, since government has to repay huge amount, it will put certain pressure on the expenditure of the government in that year. So basically look at this, borrowings in one generation is affecting the expenditures in another generation. I can understand the logical reasoning here. Borrowings done by one generation is affecting the expenditure in another generation. You will have to contain this kind of an effect. This is called as intergenerational parity or equity. What FRBM says is the government has to maintain intergenerational equity. Yes, you are allowed to borrow. No doubt you are allowed to borrow. But your borrowings should not affect the capability to spend in the future. This is called as intergenerational equity. That is the bedrock of the FRBM. What this particular FRBM discusses? One, it says that the revenue deficit has to be brought down by 0.5% every year and should be eliminated by 2007 and 8. Fiscal deficit should be brought down by 0.3% every year and should be reduced to 3% by 2007 and 8. Central government should not provide any kind of a guarantee for more than 0.5% of the GDP of the loans of PSUs as well as the state government. Total liabilities of the central government not to increase by more than 9% per year. Union government would place 3 more documents along with the budget documents: macroeconomic framework statement, medium-term fiscal policy statement, and fiscal policy strategy statement. You need not study them in detail, not required for UPSC perspective, just remember the names. At the end of the second quarter, the finance minister will submit a statement with respect to what is the trend in the fiscal indicators and what corrective measures should be taken to correct any impact of these particular indicators. So these are some of the very important points in relation to FRBM. Now please understand, Government of India was in the process of implementing the guidelines under FRBM. But because of the global financial crisis, Government of India had to forego the targets which were set up under this particular concept of FRBM. Because please understand, because of the global financial crisis, Government of India was able to collect lesser receipts in the form of taxes and had to have a higher expenditure because of expansionary policies. As a result of which, the targets under revenue deficit as well as fiscal deficit were relaxed. Now to overcome this particular issue and to review the implementation of the FRBM, Government of India set up a committee, NK Singh Committee, and this particular committee has given recommendations to the government. What are the recommendations? These are the most important recommendations. One, it has proposed a bill which is called as a draft debt management and fiscal responsibility bill, and once passed by the parliament, this will replace FRBM. This is the first recommendation. Second, it has recommended using debt as a primary target for fiscal policy, and the debt to GDP ratio should be brought down to 60% by 2023. What do you understand by the term fiscal deficit? We have already discussed the concept of fiscal deficit. What is fiscal deficit? Government, let's say in this year, will borrow 100 crore rupees from the market. This particular market borrowing is nothing but fiscal deficit of this year. And let's say government last year borrowed 50 crore rupees from the market. And since it had borrowed 50 crore rupees in the last year, that became the fiscal deficit of last year. And in the same way, government had borrowed previous year to this year 30 crore rupees from the market. And this 30 crore became the fiscal deficit of this year. Now look at this. These are the fiscal deficits of respective years. Debt basically means the total borrowings. Have you understand this? Debt means the total borrowings are done by the government. Fiscal deficit is borrowings for individual years or respective financial years. The sum total of all the fiscal deficits will give you total borrowings of the government. Have you understand this? I'll give a layman example. There's a person X. For him, if he borrows 100 rupees from the bank, this becomes a fiscal deficit of this year. 50 rupees, let's say he borrows the next year, it becomes fiscal deficit of next year. What is his total borrowing? 100 rupees plus 50, 150. This is nothing but the total debt. In the same way, government would borrow certain amount of money from the market every financial year. The sum total of all these particular borrowings will give you the debt or the public debt of the government. What this committee recommended was, rather than being always focused on the fiscal deficit, you should also focus on the public debt. And keep this as a primary target under the fiscal policy. And what is the target which has been recommended by this particular committee? It has recommended that a general debt should be 60%. What do you understand by the general debt? General debt means it is the debt of the center as well as the states. Remember this, whenever you come across the term general, it basically means the numbers related to center as well as the numbers related to states. For example, they'll say general tax receipts, general debt, so on and so forth. So, general debt should be 60%, of which 40% of GDP should come from the center and 20% should come from the states. So, this is another very important recommendation given by encasing committee. Third, to achieve this particular targeted debt ratio, it has also given a progressive program to reduce these particular debts over a period of time. From 1 year to the next year, how much should be the reduction in terms of a debt, how much should be reduction in terms of fiscal deficit until 2023. Next, it is recommended formation of Autonomous Fiscal Council, which will have a composition of 3 members, 1 chairperson plus 2 other members appointed by the government. The functions of this particular council will be preparing multi-year fiscal forecast, recommending changes to the fiscal strategy of the government, improving quality of the fiscal data, advising the government if conditions exist to deviate from the fiscal target, and finally advising the government to take corrective action for the non-compliance with the bill. So these are the recommendations of the Autonomous Fiscal Council. Next, the grounds under which the government can deviate from the targets. That is, the committee basically says, from 1 year to the next year, you are supposed to reduce the debt like this. This is the program which has been recommended by the committee. And even the council can look into this particular program and give certain recommendation to government. That is Autonomous Fiscal Council. Now look at this. In particular year, because of various internal as well as external reasons, it could be anything. There could be another collapse of the international market. There could be certain problems with the tax revenues, so on and so forth. Government will come under pressure with respect to these particular targets which have been set up. In these particular situations, to what extent the government can deviate from the target? Certain conditions have been levied or certain recommendations have been provided by this particular committee. But more importantly, in what situations the deviation is allowed, the committee says, that is, Government of India has to clearly state these are the situations, and under these particular situations, to this extent the deviation will be allowed. As per this particular committee, it has given certain considerations. That is, one, it says in case of a situation of a national security, war, national calamity, collapse of the agriculture which will affect the output as well as the incomes, deviation must be allowed. Structural reforms in the economy resulting in fiscal implications. For example, just an example, GST which has had certain fiscal implications, deviation could be allowed. Third, if there is a decline in the real output of the economy, that is the economic output reduces by at least 3% when compared to the average of the previous 4 quarters. In these 3 parameters, the deviation could be allowed. And remember this is the recommendation of the committee. And the deviation to the extent of only 0.5% of GDP will be allowed. So these are the recommendations which have been given by the committee to the government. Now, whether the government will accept these or make certain changes to these particular deviation conditions, left to the government. Next, committee has recommended that 15th Finance Commission should be asked to recommend the debt trajectory for individual states. So these are some of the very important recommendations of NKC committee. Apart from this, just have a look at certain key numbers. Again, you need not mug up these particular numbers. Just to understand how the budgeting is done, you should look at these particular key numbers. Again, I am repeating, do not mug up these particular numbers because these numbers will vary from one year to the next year. You will see the concept of the revenue receipt, capital receipt, the total receipt is this much, and the total expenditure will match the total receipt. And since there is a deficit, government will borrow from the market. This is the fiscal deficit. You will see absolute numbers given here. This, when converted or when compared to GDP, you will get in terms of percentages of GDP. So fiscal deficit, revenue deficit, effective revenue deficit, primary deficit. Why I am showing this particular representation is, once the budget is presented, you will come across these kind of tables in every newspaper or even in the documents of the government. If you have understood the concepts of a budget and the concepts of a deficit, you will not find it difficult to read this kind of a document. Next, usually you will find this kind of a representation. And every alternative year or once every 2 or 3 years, UPSC will pick up one preliminary question from this kind of a representation. And most of the time, the question is related to the receipts of the government. And within the receipt, the most favorite question of UPSC is, arrange the following in ascending order of contribution or descending order of contribution. And within this, most often the question will be related to the tax receipts. Earlier, that is before the introduction of a GST, the contribution of a tax receipts was usually in this particular form. That is, the highest contribution used to come from corporate tax, followed by income tax, followed by excise, followed by customs, or followed by services. But with introduction of a GST, this composition has changed and it will vary from one year to the next year. So whenever you come across this kind of a representation, please note down certain very important points. That is with respect to ascending order of contribution or descending order of contribution in terms of the receipts. For example, here you can see that corporate tax as well as a GST for a certain year is the same, followed by income tax, followed by the excise duties, followed by customs. And apart from this, you can also see this particular representation where it shows out of the total receipts which are collected by the government, how these receipts are used. What you must observe is one component is this, interest payments. That is approximately 20%. I'm just rounding off the number. Approximately 20% of the total expenditure incurred by the government is in the form of interest payments itself. So you can imagine to what extent the borrowings are affecting our ability to spend. If our borrowings increase today, our ability to spend in the future will become restricted because there is a component of interest payment. And we've discussed this under the concept of Fiscal Responsibility and Budget Management Act. Apart from this, look at the component of subsidies. Around 10% of the expenditure incurred by the government is in the form of subsidies. And apart from this, the most important component will be centrally sponsored and central sector schemes. Now please understand, the types of schemes which are implemented are usually classified under two heads: centrally sponsored, central sector schemes. What is the basic difference? In case of the central sector schemes, the central government implements them, and the subjects in which these are implemented usually will fall under the union list, that is under the control of the central government. financing completely is provided by the central government. The mechanism of implementation is controlled by the central government. That is the reason these are referred to as a central sector schemes. Whereas apart from this, there is also centrally sponsored schemes, wherein financing to a certain extent will be distributed between central government and state government. And the subject on which it is going to be implemented will usually be in the form of a concurrent list or in the state list. The mechanism of implementation is controlled by the state government. That is the precise reason these are called as centrally sponsored scheme. Part of the spending will be sponsored by the central government. So central sector schemes, central sponsor scheme usually account for more than 1/5 of the total expenditure incurred by the government. And apart from this, there is also certain receipts which are transferred to the states because of the recommendation of Finance Commission and other transfers. So this is how the rupee will be collected by the central government and how the rupee will be used by the central government. Apart from this, other important concepts related to the budgeting are: one, planned and non-planned expenditure. What do you understand by this? Earlier we used to have a concept of a 5-year plans, and the projects which were announced or which were to be implemented under 5-year plans, many a times the financing for these particular projects would be done under various budgets or respective financial year budgets. That is, the allocation under the budget will be done to achieve the objectives of the 5-year plan. Such an allocation of expenditure is called as a planned expenditure. Whereas other expenditures which are not associated with achieving the objectives of the 5-year plans were called as non-planned expenditures. But since we have dismantled or discontinued the idea of a 5-year plans, Government of India has also discontinued the idea of a planned as well as non-planned expenditure. Rather than using planned and non-planned, today they are using revenue expenditure and capital expenditure concept. Second, gross budgetary support. Gross budgetary support or GBS basically refers to, out of the total expenditure that has been proposed by the government, how much is the component of the central plan. For example, the CPSCs will be allocated with certain expenditure, but the total expenditure incurred by the CPSCs could be higher than this particular amount. For a simple reason, if this CPSC has got certain profits, it could use a certain amount of the profits or part of the profits along with this expenditure to implement this particular project. But look at this, if the project incurs, let's say hypothetically 100 rupees, but the central government has contributed only 40 rupees and 60 rupees is from the CPSCs, just itself 40 rupees will be gross budgetary support. That is how much component is coming from the central government. That is gross budgetary support. Next, concept of a rolling over. Please understand this. In case of the expenditure incurred by the government, such as subsidies, what usually happens is this: a component of a crude, such as kerosene, such as LPG, are subsidized. In simple terms, the actual market prices are higher. Certain amount is incurred or given by the government, as a result of which, when these particular goods are supplied to the households, the prices are lesser. Just a hypothetical example, if the cost of kerosene was 100 rupees per liter, government would pay, let's say hypothetically 30 rupees to an OMC, as a result of which this OMC would supply the kerosene to the households at 70 rupees per liter. But more importantly, Government of India has incurred a subsidy of 30 rupees. That is a part of the revenue expenditure. Now look at this. This particular concept of a subsidies is incurred by the government on annual basis. That is, when the union budget is announced, government allocates a certain expenditure to take care of the subsidies. But let's say hypothetically, the cost of a crude in the international market increases. And when the cost of the crude in the international market increases, this particular market price for kerosene will also increase. But Government of India, to ensure that kerosene is supplied to the households at subsidized prices itself, increases the subsidy. I can understand this. Let's say hypothetically, earlier the price was 100 rupees, Government of India incurred a subsidy of 30 and as a result of this, kerosene was supplied at 70 rupees. Again, all these are hypothetical numbers. Now let's say hypothetically, because of increase in the international crude oil prices, the price of the kerosene increases to 120 rupees. Now if Government of India incurs a subsidy of same amount, that is 30 rupees, the price of kerosene to the households will increase. To protect the households from this kind of an extra expenditure, government incurs a higher subsidy. But please understand this, government many a times basically rolls over these particular subsidies. Now what do you mean by rolling over of the expenditure? It basically means OMCs will have to borrow and ensure that the households will continue to get the kerosene at the same price, that is at 70 rupees. But government will pay the subsidy of only 30 rupees this year and the remaining 20 rupees will be paid to the OMC in the next year or in the subsequent years. Have you understand this? Earlier the subsidy was how much? 30. The kerosene was supplied at 70. Now as a result of this, the price has increased to 120. So as to ensure kerosene is supplied at 70, the subsidy amount has to be increased how much? 50 rupees. But government in the budget has already allocated only 30 rupees for kerosene. Now what government says to the OMC? You borrow from the market and ensure that kerosene will continue to be supplied at 70 rupees only. And this 20 rupees a subsidy, I will give it to you in the next year or in the subsequent year. This kind of a shifting of the subsidy payment by the government or any kind of a payment by the government to subsequent years is called as rolling over. Next, off-budget financing. What do you understand by the concept of off-budget financing? It basically means government is using various tools or various processes to generate receipts, but these receipts are not part of the budget documents. I'll repeat it. Government of India is using various systems or tools to generate receipts, but these particular receipts or income are not part of the budget documents. I'll give an example. Government of India may propose merger of one CPSC with another CPSC. That is selling of this CPSC to this CPSC. As a result of this CPSC, that is buying out the previous public sector enterprise, will pay the money to whom? To Government of India. Our Government of India may borrow from various other accounts which are under the executive control of the government. So look at this. These kind of incomes which are generated by the government are not part of the budget document, but nevertheless are used by the government to generate receipts. This is called as off-budget financing. So these are some of the very important concepts related to the concept of budgeting. Now let's have a short discussion related to the concept of a railway budget. First and foremost, remember this, there is no constitutional provision which dictates a separate railway budget. That is, no article in the constitution says that there has to be a separate railway budget. Railway budget is continued by the government post-independence as a convention. That is, before independence, there was a committee which was set up called as Ackworth Committee. This particular committee recommended that there should be a separate railway budget. That is the reason in the mid-1920s, we started to have a separate railway budget. And we started to follow this particular convention even after the independence. But over a period of time, the importance of railways has come down. And as per recommendations given by various committees, such as Bibek Debra Committee, since there is no constitutional mandate to have a separate railway budget, why don't we merge the railway budget with the union budget? And based on these recommendations as well as various other features or parameters, Government of India has merged railway budget with the union budget. Earlier, please remember this, the sequence was the railway budget will be presented and after this the union budget will be presented. And between both of them, the economic survey was to be presented. But now, this particular railway budget has been merged with the union budget, hence there will be only one budget which is presented, that is union budget. What are the reasons which have been cited by the government for this kind of a merger? One, size of the railway budget over a period of time has shrunk. That is, over a period of time, the size of the railway budget or the expenditure incurred by the railway budget has come down. At one point of a time, the size of the railway budget was even lesser than the size of the union budget in terms of expenditure. So basically, there is no need of having a separate railway budget because of this. Second, recommendations of the committee such as Vivek Debro committee. It stated that since there is no constitutional mandate to have a separate railway budget, why do you want to continue with the convention? Just merge this particular budget with the union budget and have only one budget. Third, you need to have a seamless national travel policy. That is, you need to develop efficient infrastructure for transportation. You cannot have finance ministry allocating expenditures for projects in civil aviation, ports, roads sector, so on and so forth, and parallelly the railway ministry allocating financing for the projects only in the railways. This will lead to duplication of efforts. This will also not lead to a seamless national travel policy. Hence, to ensure a seamless national travel policy, now the finance ministry will allocate the financing for all the infrastructure projects such as aviation, ports, roads, even the railways. And the final reason, the 7th Pay Commission recommended hike in the salaries. As a result of this, at one point of time, one survey stated that expenditure incurred by the Ministry of Railways will cross or will just jump from 53,000 crore rupees to more than 78,000 crore rupees. And this particular amount in the form of a salary bill will be more than 40% of the total expenditure incurred by railways in the form of railway budget. I can understand this. With implementation of the recommendation of 7th Pay Commission, the salary bill of railways will also increase for a simple reason. Railways is one of the largest employment generators in India. Now, as a result of this, the salary bill will balloon from more than 53,000 crore rupees to more than 78,000 crore rupees. And this amount is almost more than 40% of the total expenditure allocated on the railway budget. This will put an undue pressure on the Ministry of Railways. And already the Ministry of Railways is suffering losses in the passenger segment. To reduce this kind of a burden, the railway budget has been merged with union budget. So these are some of the very important reasons citing which union government through an executive order merged railway budget with union budget. As a result of this, now we have got only one budget, that is a union budget. So these are the various points related to the concept of a budgeting. Let's look at some of the important questions. 1. Consider the following questions. Vote on account deals only with the expenditure side of the government's budget. We have discussed this particular concept. Yes, vote on account deals with the expenditure side. And vote on account basically is what? Earlier, 1/6 of the value of appropriation bill was allowed to be withdrawn by the government as a form of a vote on account. Interim budget does not give the complete financial statement like a full budget. We already have seen the concept of an interim budget. In case of interim budget, it provides the expenditure side as well as the receipt side. So second statement is wrong, first statement is true. Right option will be option A. Which of the following taxes form part of the receipts of the revenue account of the budget? Income tax, yes. Corporate tax, yes. Customs duty, yes. Right option will be all of the above. Which of the following are components of the capital expenditure in the budget? Government expenditure on machinery related to an asset, so yes. Loans and advances by the central government to the state government, again loan is an asset, so yes. Salary of officials of the government departments, this is salary. Salary is a part of the revenue expenditure, not capital expenditure. So first point is correct, second point is correct. Right option will be option A. Next question, consider the following with regard to the union budget. It shows estimated receipts and expenditures for the following year, that is budget estimates, yes. It shows revised estimates for the current year, Yes, we've already discussed this in the beginning of the budget. It shows actual receipts and expenditures for the previous year. Yes, all the three are correct. So the right option will be option D, all of the above. With reference to the union government, consider the following statements. The Department of Revenue is responsible for the preparation of the budget and is presented in the parliament. This is wrong because it is a Department of Economic Affairs. No amount can be withdrawn from the Consolidated Fund of India without the authorization of the Parliament of India. Yes, that's right. All the disbursement made from the public account also need the authorization of the Parliament of India. This is wrong. I'm pretty sure you've learned about the public account under the concept of polity. In case of the public account, it is the executive priority. That is, executive order is important either to deposit or withdraw the money from this particular public account. Hence, it is controlled by Government of India and there is no need of authorization from the Parliament. So the right option will be option C, second statement only. There has been persistent deficit budget year after year. Which of the following actions can be taken by the government to reduce this particular deficit? Reduce revenue expenditure. Will it reduce the budget deficit? Yes. Introduce new welfare schemes. This which are very important from the UPSC perspective. Subsidies. Yes, it will reduce the revenue was the experience in financial matters and administration person with of the Consolidated Fund of India. Plus 4. One is the chairman and the 4 are the other members. What is the qualification? The appointment of a finance 5 years or since the president to understand with. So these are some of the very important questions associated with the concept of a budgeting. The next topic that we'll be discussing will be the concept of Finance Commission. Some of the basic concepts that you need to understand with respect to Finance Commission are: 1. It's a constitutional body which has been set up or which will be set up under Article 280. Now, who sets the Finance Commission? Since the President of India is the executive head of India, he will authorize the setting up of the Finance Commission. And this setting up will be done once every 5 years or even before the end of 5 years. Whenever he feels that there is a need of a setting up of a Finance Commission, he shall authorize the appointment of a Finance Commission. Now, the Finance Commission will consist of 5 members. 1 plus 4. 1 is the chairman and the 4 are the other members. What is the qualification to be appointed as a member or the chairman of Finance Commission? These are the qualifications. Please don't mug it up. Not important for a simple reason. These are very general qualifications. Look at them. Chairman must have an experience in public affairs, judge of a high court or one who is qualified to be a judge of a high court, person who has a specialized knowledge in finance and accounts of the government, person who has the experience in financial matters and administration, person with special knowledge in economics. So this is the qualification to be appointed as a chairman as well as the other 4 members. These are very general in nature. Now, apart from this, Government of India has passed 2 amendments related to Constitution of India. 80th Constitutional Amendment and 88th Constitutional Amendment in 2000 as well as 2003 respectively. As a result of this, how the Finance Commission will give recommendation, or to be more precise, what kind of revenues of the government will be considered while giving a distribution is very important. Now, what do you mean by the revenue? What do you mean by distribution? You will understand in a minute. The tax sharing recommendations do not form part of the Consolidated Fund of India. These are some of the very important basic points related to the Finance Commission. But most important concept is associated with the functioning of the Finance Commission. That is, let's say the President of India will appoint a Finance Commission and the Finance Commission is supposed to give recommendations. Now, in which area these recommendations have to be given, that is dictated in the concept called as a term of a reference. Term of a reference basically means these are the areas in which the Finance Commission shall give recommendation to the government. And every committee which is set up by the government will be given these concepts of a term of a reference. So look at the term of reference of the Finance Commission, which are very important from the UPSC perspective. One is the distribution of taxes between the center and state. Or they will also use a term called as a horizontal devolution formula and vertical devolution formula. What is the importance of that? What do they mean? Let me explain to you. Central government will impose and collect certain types of taxes. That is, under 7th schedule of Indian Constitution, various powers are distributed between center and state. One of the powers is related to financial powers, that is a taxation powers. Central government is allowed to impose and collect various forms of taxes. The most important taxes is income tax, corporate tax. Because if you remember the discussion related to the budget, more than 1/3 of the total taxes collected by the central government will come from these kind of sources only. Now, having said so, don't you think some of these particular taxes which have been collected or some of the receipts which have been collected by the central government should be given to states also? That is, even the states have got the claim over part of the income taxes, part of the corporate taxes. In the same way, central government will impose and collect many types of tax revenues. And all these particular taxes which are collected by the central government will be put in a pool called as divisible pool of taxes. Remember this, it is called as divisible pool of taxes. From the divisible pool of taxes, how much should go to the center, how much should go to states, and the money that has gone to the states, in what way it has to be distributed amongst the states. This is called as a vertical devolution and this is called as horizontal devolution. The Finance Commission will give you a formula with respect to vertical devolution, will also give formula with respect to horizontal devolution. Those are known as a horizontal devolution formula and vertical devolution formula. Or else generally this particular function will be said like this. The Finance Commission will give a recommendation with respect to distribution of taxes between center and the states and amongst the states. When they say between center and the states, it is vertical devolution formula, and when they say amongst the states, it is the horizontal devolution formula. This is the most important term of a reference of a Finance Commission. And most of the times, the discussion related to Finance Commission will be centered around this particular concept only. Apart from this, what are the principles which are going to govern the grant in aid to the states by the center? There are various grants given by the government. One type of a grant is grant in aid. What should be the principles based on which the center shall give the grants in aid to the states? That will be governed or that will be given by the Finance Commission. Third, the measures which are required to augment the consolidated fund of the states. Remember this, the consolidated fund of the states is the very important point here. So, through what measures can we increase the augmentation or the collection in the consolidated fund of the states? It is one of the recommendations. Any other matter that is referred to it will also be part of the term of a reference. So, these are the most important terms of the references based on which Finance Commission will conduct a study, give the recommendations to the President, that is nothing but Government of India. Now, why these particular recommendations are very important? That is specifically focused on the vertical devolution formula and horizontal devolution formula. Now look at this. The central government will provide funds to the states, and these particular funds will be in many forms or various types of transfers. One very important transfer is the transfer in the form of a tax share. Another very important is a grants to the states, and another very important is grants to local bodies. And if you see this particular concept of transfers between center to state over a period of various finance commissions, majority of the transfers, that is more than 80% of the transfer from center to state has been taken in the form or has been given in the form of the tax share itself. And this particular tax share is nothing but the devolution of funds. Now this is one point, that is majority of the transfers are in the form of devolution of taxes. Done. Second very important point is this. Whenever such transfers are done between center to state or from center to state, these could be in the form of tied funds or untied funds. What is the meaning? I'll explain now. When you say tied funds, central government shall transfer certain funds to the states, but with a condition. What is the condition? For what this particular money is supposed to be used by the states. Have you understand this? Center will transfer the funds to the states, but will dictate in what way or for what purpose the states shall use these particular funds. Such funds are called as tied funds. Whereas untied funds are those funds which are transferred from the center to state without any condition. In simple terms, state can use these particular funds for any purposes that it wants to. These are called as untied funds. Whenever these transfers will happen under the recommendation of 14th Finance Commission, especially the devolution of tax share, it is in the form of untied funds. So the prerogative of the usage is left to the state governments. They can use it for any purposes that they want to. So these are the two reasons why the recommendation of the Finance Commission is very important. One, majority of the transfers, that is more than 80% of the transfers in the last 4 Finance Commissions have come in the form of the tax transfers itself. And second, these particular transfers are in the form of untied funds, as a result of which the states can use it without any conditions imposed by the central government. So this is why the recommendations are very important. Now, what has been the evolution of the recommendations of the Finance Commissions? 11th, 12th, 13th and 14th. Please look at the recommendations. This particular recommendation basically represents how much is the share of the states out of the divisible pool. That is the vertical devolution formula. Out of the total taxes collected in the central divisible pool, how much will go to center and how much collectively will go to states. This has been provided here. In the 11th Finance Commission, 29.5% of the DPT went to states, remaining went to central. In the 12th, it increased to 30.5. In the 13th, it increased to 32%, and in the 14th, you will see a sudden jump to 42%. So remember this, 14th Finance Commission, in terms of the vertical devolution formula, gave the highest recommendation to have a tax transfer or to have a highest transfers from the divisible pool of taxes to the states. Earlier, there was a very conservative increase. You will see increase by 100 basis points here, increase by 150 basis points, and suddenly you will see an increase of 1000 basis points here. Now remember this, 100 basis points is equal to 1%. So you will see a hike in 100 basis points, hike by 150 basis points, and a hike by 1000 basis points. A sudden jump in terms of a vertical devolution formula. That is the reason many of the books will mention that the recommendation of a 14th Finance Commission, that is specifically vertical devolution formula, as a watermark in the evolution of transfers between the center and state. Because this kind of a sudden jump in the transfers was not seen earlier. And remember this also, the recommendation of the 14th Finance Commission are advisory in nature to the central government. And usually the central government will abide by the recommendations given by the Finance Commission. For example, though the vertical devolution formula was suddenly expanded by the 14th Finance Commission, central government accepted this particular recommendation. As a result of which, out of the divisible pool of taxes, the share given to the states has increased to 42%. So this is relation to vertical devolution formula. What will happen in case of horizontal devolution formula? That is, yes, out of the divisible pool of taxes, as the recommendation of 14th AFC, the states collectively will collect how much or will get how much? 42 rupees. But how this 42 rupees will be distributed amongst all the states, that will be dictated by another formula called as horizontal devolution formula. And this particular horizontal devolution formula will vary from recommendation of one Finance Commission to another Finance Commission. For example, you can see there is a difference between the weightages given to parameters which are considered for horizontal devolution. You did not mug up these particular parameters for a simple reason. The questions have already been asked by UPSC with respect to 14th FC. So look at this. In case of the 13th FC to 14th FC, earlier in the 13th FC, weightage of 25% was given to population of 1971 only. And 14th FC became the first finance commission to give a certain weightage to population of 2011 also. And that is being discussed even in the 15th FC, 15th Finance Commission. Apart from this, it also introduced a new parameter, that is the forest cover. For the forest cover, the weightage given was 7.5%. It simply means that state which has got the highest forest cover or higher forest cover will also get higher allocations. And the state with highest population or higher population will also get higher allocations. So this is the way a horizontal devolution formula is recommended by the Finance Commission. Now, as a result of these particular vertical devolution formula and horizontal devolution formula, some of the very important features which are applicable to 14th FC are: it has given a new horizontal devolution formula, has included two new variables or parameters, that is the forest cover and population of 2011, to give a new vertical devolution formula. Other types of grants which are proposed were grants to rural and local bodies, performance grants, disaster relief grants, so on and so forth. And the total transfers under this particular other types of grants between center to state or center to the third tier of government will be more than 5.3 lakh crore rupees. So these are some of the very important features that are applicable to 14th Finance Commission. Now the President of India also has appointed the 15th Finance Commission. What are the important terms of references of 15th Finance Commission? First, as usual, it has to give vertical devolution formula and horizontal devolution formula. That is distribution of taxes between center and states and between or amongst the states. That is one recommendation. Second, how to augment the consolidated fund of the states. That is second term of reference. And third, as usual, is related to the principles in relation to granting aid. So these three, as usual, are the terms of references of 15th Finance Commission. And the fourth term of reference is any other matter that is referred to it. Under this particular term of reference, the 15th Finance Commission has been allocated with a huge number of terms of references to be studied and to be given in the form of recommendations to the government. What are some of the important term of references under this particular other subjects which are referred to it? One, it has to review the impact of the 14th Finance Commission on the finances of the center and give certain recommendation. It has to review the debt level of the center and state and recommend a roadmap. Third, study the impact of a GST on the economy. Fourth, recommend performance-based incentives for states based on their efforts to control population, promote ease of doing business, control expenditure on populist measures, so on and so forth. And fifth, should there be a revenue deficit grant? What do you mean by revenue deficit grant? State government will also announce the budget, and just like central government, it will also have a revenue deficit. To bridge this revenue deficit, central government will transfer certain grant. This particular grant is called as a revenue deficit grant. So another term of reference that has been given to the 15th Finance Commission is, should there be a provision of revenue deficit grant? So these are some of the other important terms of references which have been given to the 15th Finance Commission, apart from the three very important term of references related to distribution of taxes, with respect to augmentation of consolidated fund of the states, with respect to the provisions related to granting aid. Now, what are some of the concerns which have been raised with respect to these particular terms of references? One, should we really abolish the revenue deficit grant? Because please understand, central government will propose the policies many a times, and these particular policies on the ground level are to be implemented by the state government. Now, irrespective whether the state government wants this policy or not, since it has been proposed by the central government, it will be implemented by the state government. As a result of this, don't you think state government is going to incur a deficit in the form of revenue deficit? And to bridge the revenue deficit, center is transferring certain funds or certain grants which are called as revenue deficit grant. Now in this particular situation, where this kind of a relationship exists between central government and the state government, should we abolish the revenue deficit grant? Because if you abolish the revenue deficit grant, there will be a huge financial pressure on the finances of the central government. This may hamper the implementation of various welfare schemes or various welfare measures which are proposed by the central government but implemented by the state government. So this is one concern. Second, the case of incentives. In the earlier slide or in the previous slide itself, there was a term of reference in relation to giving incentives to various states based on their performance with respect to one, promotion of ease of doing business, second, control the expenditure on populist measures. The experts now question, how do you define a populist measure? Because a measure or a policy of a certain party in a certain state could be prudent for itself, but it may be viewed as a populist measure by the central government. And in case of India, where you will see a multi-party system, that is at the center there is another party, and at the various states there is another party forming the governments. In this particular situation, what if the central party, and in this particular situation, what if the central government, which is formed by a different party, views this particular measure implemented by the state government and says that it is a populist measure and you are not controlling the expenditure on the populist measure, so I may not give you any kind of an incentive, or the incentive will be reduced to you. So basically, the definition of a populist measure is not universal. It may vary from one government's viewpoint to another government's viewpoint. This will lead to certain issues of providing incentives. Another issue which has been discussed is the term of reference asks the Finance Commission, can we give incentives based on which state is promoting more ease of doing business? Now, you can look at the concept of ease of doing business in two ways. One, you can simply say you are promoting functioning of a business by liberalizing the system. That is, you are making it very easy to conduct a business. That is the idea of a promoting of ease of doing business. The other way of looking at it is, you are basically withdrawing the regulations in the system. That is, let's say there was a regulation with respect to how you are supposed to treat the effluents, how you are supposed to treat your exhaust gases, how you are supposed to treat X, Y, and Z. Now, to promote ease of doing business, can I simply say withdraw of these particular conditions or regulations is helpful? But the question is this, if these kind of regulations are withdrawn, don't you think you are giving a free hand for the private sector, which might be misused by the private sector? So the question is, by giving more incentives to the states which are going to promote more ease of doing business, are you promoting a race to the bottom of regulation? Are you asking the state governments to withdraw these particular regulations and give undue powers to the private sector, which might lead to certain harmful outcomes? So there is another concern which has been raised here. Third and the most important concern is opposition from some of the southern states. What is the argument which has been put from the southern states perspective? Understand this. Argument is simple. The term of reference related to the distribution of taxes says that the Finance Commission may use the population of 2011. Now the southern states have got multi-point arguments here. One, they say that post-independence, especially post-1970s, the southern states have controlled the population much effectively compared to northern states. I'll repeat the statement. The southern states have been effective in controlling the population compared to northern states. As a result of which, the population in northern states is almost twice compared to the population in southern states. Now, if you give weightage to 2011 population, don't you think because of a higher population, the northern states will get higher allocation compared to southern states? Now, the southern states are saying they are being penalized for controlling the population. That is one argument. Second argument is, majority of the production states or majority of the tax contributing states are present in the southern side. A substantial part of the GDP, substantial part of the taxes collected by the government comes from the southern side. And when it comes to distribution of the taxes, favorability is provided, or because of the various parameters decided by the Finance Commission, most of these transfers are going to northern states. Now they argue that when we are contributing to the tax receipts, we are contributing to GDP, don't you think we must be also given the transfers in a sufficient manner? These have been certain issues which have been raised by the southern states because of the terms of reference of the 15th Finance Commission. So these are the concerns which have been raised. So this is the discussion related to the concept of a Finance Commission. Now let's have a look at certain questions. With reference to 14th Finance Commission, which of the following statements are true?